Hey everyone, welcome back to another edition of That's Our Two Satoshis Live. For those who have never been a part of this before, we write a blog about digital asset markets every week called That's Our Two Satoshis. You can find it on our website at ar.ca. And then we come out here and talk about it. I'm Jeff Dorman, Chief Investment Officer, and I am joined today by hopefully someone you guys already know, Greg Foss. How you doing today, Greg?
Things are great, Jeff. Thanks for having me. I'm actually over in Bulgaria in a Bitcoin tour. So yeah, hopefully our reception isn't too poor.
Well, it sounds good so far. So hopefully things are going well over there in Bulgaria. So to kick things off, Greg, the reason I wanted to have you on here, and for those who don't know, Greg and I actually go quite a bit back ourselves. We were both fixed income traders and portfolio managers over a decade ago, and Greg's got a much longer career than I do, although we're both old men in finance. But both Greg and I grew up in the fixed income world, trading bonds, trading credit default swaps. And, for those who have been listening or reading what I've written for years, I don't talk about Bitcoin that much. I love Bitcoin. I own a lot of Bitcoin in my personal account. It was what got me into digital assets. But I generally focus on a lot of other areas of digital assets more so than Bitcoin. But today we're going to be mostly Bitcoin focused. So before we get started, quick disclaimer, this commentary is not intended to be investment advice, investment research, or a recommendation. Please consult your investment professional for your own circumstances. That said, we're going to talk about Bitcoin. And the reason I think Bitcoin is really interesting again here is there's a lot of things going on in the world right now that are not super great. First, you can talk about investment returns. You can look at, treasuries down, 20 to 30%, depending on where you're looking at it. Obviously, you're now seeing the UK gilt market doing pretty poorly as well. You're seeing European bank stocks and bonds getting crushed, led by Credit Suisse and to some extent BNP. Equity market, we all know what's going on there. And of course, digital assets. Most people always talk about Bitcoin as it pertains to an inflation hedge or a store of value. But Greg was the author of an incredibly detailed white paper talking about framing Bitcoin more in the framework of credit default swaps and as portfolio insurance on what we all see, which is a kind of a declining value of fiats and even further than that, really trust in governments and trust in even large banks to some extent. So, Greg, why don't I turn over to you? What made you, obviously you have a fixed income background, but what made you first think of Bitcoin in this light? And maybe you could walk through for the audience just how you think about Bitcoin as it relates to credit default swaps and what's happening in the market right now.
Jeff, and yeah, I'll reiterate what you said, that both of us got our seed markets, and I believe, and I think Jeff would back me up on this, is that credit runs the it's the largest asset class in the world. It's also the top of the capital stack. Therefore, when credit gets sick, subordinate claims like equities around like a rag doll at times, and this is what we're seeing in the credit market now. But we're also seeing it in the credit markets because the plumbing of the current credit system. We all know the reasons, but it's quite a serious situation. So, yeah, a couple of years ago, paper that described Bitcoin as a credit default contract on a basket of fiats. And the beautiful thing about that is counterparty risk, and it has no theta or time essentially an indefinite insurance contract on the potential collapse fiat within a basket. And the reason that I framed it because of the credit history that we both share, but also describe Bitcoin in a sentence. I would describe it as it's a scarce asset. It's controlled only math and code. There is no centralized function within. That reason, I view it as the digital asset that solves what has concerned, which is the fiat system. And I'll even go so far as saying Ponzi. And the fiat Ponzi starts with credit. when limited printing of money and essentially a banking system that is too big to fail because it will be bailed out by the government. Tool that they use to bail out credit is printing. So I hope that context flows to the audience, and it's only because both of us have spent more than a few decades that risk share that I can say with confidence that that's how I view it. But time for that narrative to permeate the investment landscape. Or that being said, it allowed me to put a valuation on Bitcoin, valuation on the intrinsic value of Bitcoin using credit default swap G20 nations. And that's a dynamic measurement that will change over the swap spreads widen. Think of it as insurance increases as the swap spreads widen. And if you own that insurance protection, it becomes more valuable.
Yeah, so let me jump in there for a second. For some context here, it's interesting because I used to always price Bitcoin in as an option, right? I used to look at it from a Black-Scholes perspective. If you look at, the 5 inputs of Black-Scholes, 3 of them were very favorable for Bitcoin, right? One is volatility, right? The higher volatility, the higher an option value, and obviously Bitcoin has a ton of volatility. 2 is interest rates, right? Even with the big backup in rates recently, we're still at historically low rates and certainly negative real rates, which is a positive input in terms of what the price of an option would be. And then also you have time, right? And because Bitcoin is basically an infinite time horizon, right? It's like owning a perpetual call option. The time value never goes away. So I always thought Bitcoin from that standpoint was always valuable, and it was hard to come up with what the right price was, but you always knew that Bitcoin had some value purely as an option on, call it government anarchy or lack of faith in sovereign states or banks or what have you. And then when I thought further about what you were talking about, I was like, okay, well, actually the CDS analogy, even though, credit default swaps is not really an option, to some extent, it looks like an option, or at least, a similar derivative. For those who don't understand how credit default swaps work, I'll give you an example. Typically you buy a bond, the bond is priced at par. It doesn't really matter what let's say it has a 5% coupon on that bond. All of a sudden that company gets way riskier and the bond goes to an 8% yield. Well, the coupon doesn't change. It's still 5%. Therefore, the bond price has to be lower in order for that 5% coupon to still equal an 8% yield. Well, that doesn't really matter from a credit default swap standpoint. It'll make the credit default swaps that CDS will reflect that riskiness, but ultimately you don't get paid out on that unless the company actually defaults, and therefore you get some impairment on that par price on your bond. So when you're thinking about sovereign CDS, for example, the CDS can widen or tighten. It doesn't necessarily mean you're going to have an imminent default, but it reflects that same level of what should the actual yield be? What is the actual risk inherent in this institution? So for instance, if you have let's say you have a country and the CDS is trading at 50 basis points, that means that you have to pay 50 basis points per year in order to ensure the par value of that bond, meaning that you would get that money back if you bought a government bond. So if you look at what's happening in the CDS world right now, it's all wider. I mean, whether you're talking about corporate credit, whether you're talking about sovereign or bank credit. I mean, I'll give you some examples here. The United States right now is only 32 basis points a year, which sounds like not a whole lot of money, right? You pay, less than you pay about 0.3% per year to insure the bonds. Sounds like not a lot of money, except that that's up 17 basis points on the year. We started the year closer to 15 basis points for what it would cost to insure U.S. government debt. And then further, if you actually look at how much debt there really is, I mean, there's almost 30 trillion of U.S. government bonds outstanding. You're talking about almost $100 billion a year that it would cost to insure all of the debt of the U.S. government. Well, it's not just the U.S., right? Look at Brazil. Brazil is 100 basis point wider on the year. Mexico is 100 basis points wider on the year. Canada is 20 basis points wider on the year. UK is 30 basis points wider on the year. You can go to Greece, which is 130 basis points wider, or New Zealand, 20 basis points wider. I mean, all these sovereign CDS levels are much wider on the year, which basically is another way of saying the world is starting to price in higher risk premium for whether or not these governments are going to be able to make due on their debt obligations. Well, that's the exact same argument that Bitcoin has, right? You effectively are owning Bitcoin because it is what happens if these government can't make due on their debt obligations and currencies spiral out of control. So, which brings us to what I'm trying to get at, which is it makes absolutely no sense that you have bank CDS wider and government bond CDS wider, but Bitcoin down 70% on the year. Like those two should be moving in lockstep, and they're not. So, Greg, I'd like to turn it back to you. I know you have a little spotty connection, but is that sort of similar to how you're thinking, that this just is a relationship that makes no sense?
I agree 100%, Jeff. I'd like to just build on a couple of things you said. Start with the fact that a CDS contract, to make money, it doesn't have to actually default. You can profit, you own it, and then sell it, as you know. Some of the listeners may not have understood that. If you buy a CDS contract, you own the insurance at 25 basis points. Contract spread widens to 50 basis points. There's an actual price increase on the value, turn around and sell. Now, that's just open market reality. That lots of people on Wall Street do trade CDS contracts. They are options contracts. You know the correlation between VIX and CD. In fact, owning protection is actually being long volatility, a very, very important component, as you know, Jeff, to a diversified portfolio, because most volatility assets. Now, we're getting pretty deep here, but the reality is it's time for Wall Street to understand these things. So Bitcoin has been traded off asset, and I'm not anticipating it changing anytime soon, but I do study it more as a long volatility asset, i.e. owning insurance. This is the language more and more. Let's take it one step further with the USA, though. USA has 31 trillion of funded debt, but another 170 trillion funded debt. And I like to combine those two, and that 200 of total U.S. debt, you can get some pretty big numbers is what insurance on the USA is. I shared with you a tweet. Maybe you could share it with the audience. You calculate, one of the ways of looking at Bitcoin is you're getting insurance on for a much lower price than if you had to insure that $200 trillion of debt in the open market, and you're getting all other countries in the world for free. Now, that's the key thing. I think we would all believe that the USA is not at imminent risk of default, but you're getting the insurance on the other countries for a price. In fact, you're getting them for free. So I hope people think of it that way. Other thing that I need to stress is I think of Bitcoin actually as a put. It makes no difference whether you were looking at it as a call option or a put option. Makes no difference as a put on the Fed put, Jeff. And so we could get really, really deep if we keep it at a level where it's an ability to calculate an intrinsic value, because a lot of people say it has no intrinsic value. Well, I'd like to argue it's a very, very cheap form of insurance where you're getting at a fraction of the true value, and you're getting everything else, every other country, which are mates for free.
Yeah, and I think the tweet that Greg is referencing, we actually did put that in the blog. So again, you can check it out on our website, ar.ca/blog. But what he's basically getting at is 5-year CDS on the USA debt right now trades around 30 basis points, which means if you were to insure the entire amount of debt, and what Greg was saying is there's 30 trillion of funded debt, but there's another 170 trillion of unfunded debt, and I assume that means everything from Social Security to Medicare and every other liability that the U.S. government has ultimately to pay. So if you're looking at $200 trillion of debt, and you take that 5-year CDS at 30 basis points, and you look at a normal credit curve, and you say maybe call it 20-year CDS is about 120 basis points or so. If you multiply 200 trillion of debt times the 120 basis points per year, that basically means that it would cost $2.4 trillion a year just to insure all of the debt that the U.S. has. And if you compare that $2.4 trillion premium compared to what Bitcoin's current market cap is, which is only 370 billion, you can see there that you're looking at a significant discount, almost an 85% discount to fair value if you buy Bitcoin instead of buying credit default swaps on the US. And then to Greg's point, that's just talking about US debt. If you look at all the other debt out there, there's another 50, 60 trillion dollars of debt across other nations funded, not even including the unfunded debt, combined with all of the bank debt of Credit Suisse alone has another 128 billion of unsecured debt, for example. So you look at all of these debt obligations and you think about the annual cost that the market would tell you it would cost to insure all of that debt. And instead, you look at what Bitcoin is trading at, which is a one-time payment, right? You don't even have to make those payments annually. That's just a one-time payment. You could certainly make an argument that Bitcoin is just severely, severely mispriced. Now, again, you could also make the argument that CDS of these nations is priced wrong as well, but that's a much more developed market, been around for a lot longer, has a lot more players transacting on it. I think Greg lays out a really strong case for why Bitcoin is severely undervalued relative to this framework. And the reason we wanted to write about it this week was things are getting worse, not better. I mean, Greg initially came out with this idea. I don't know what it was, certainly almost a year ago, right, when you first came out with this thesis. Things have only gotten worse since, right? I mean, as we mentioned, CDS in every sovereign nation is blowing out. Overall credit risk at large, basically pseudo-nationalized banks is blowing out. The situation is worse, and yet Bitcoin is 60% cheaper, while all these credit default swaps are 50 to 100% more expensive. So look, the math is what it is. I think Greg's analysis is really great. We actually linked to his initial white paper in the blog as well, which is about 40 pages, but it's a very, very good read. Would love to hear your thoughts. I know Greg's got a spotty connection today, but maybe we'll have him back on when he's back in the States or back in Canada at some point in the future to go even deeper here. But I encourage you guys to read the blog, read his white paper, look at some of his tweets. You can find him at Foss, Greg Foss on Twitter. And I'd love to hear your thoughts between Greg and myself and a bunch of other people in this digital asset world who are former fixed income guys or gals. There's a lot to be learned from what happens in credit markets. And I think people would be wise to kind of learn about what's happening in corporate and sovereign credit and start applying it more to digital assets. So we'll let you get some sleep, Greg. I know it's late there. Really appreciate you jumping on to joining us. We'll be back again next week. Greg, anything else to say on your way out?
From Bulgaria. And yeah, I wrote the paper 20 months ago, Jeff. And one thing hopefully some people took profits on their bond positions 20 months ago, how silly rich the bond markets were everywhere from high yield to rates on sovereign debt just made no sense to me. So anyway, as you said, absolutely carved this year. Double-digit losses across of the asset maturities, and that's in that balancing against equity losses. This is historic losses in risk markets. Only Bitcoin. Sorry about the spotty connection from Bulgaria. I'd love to come back on your show.
Great. Well, you're always welcome back. All right. We'll get some sleep out there, Greg. We'll catch up again soon. Thanks again. And everybody, that's our 2 Satoshis this week. We'll see you next week. Thanks, everybody.